If you're like me, you've been waiting and waiting for a good chance to buy Nvidia. Nvidia is a great company. The problem is everybody knows that. And because of that, the price has been so high. But in the last 3 months, Nvidia has dropped over 30% from its all-time high of $150. It's now sitting around $100. Is now finally the time to buy Nvidia? That's the question I'm seeking to answer in this video. The way I determine if a company is a good purchase or not is by doing a future free cash flow analysis. I discount their future free cash flows to calculate their intrinsic value today. And with Nvidia, before I get into their numbers, just looking at the quality of the company, they look so good. So here's my automated spreadsheet. I type in the ticker, it automatically pulls a bunch of information off of stockanalysis.com. And this is where I do my automated red flag analysis. I use Warren Buffett's red flags that he uses to analyze companies. Basically, if a company has too many red flags, it's not likely to have a durable competitive advantage. And Nvidia clearly has a durable competitive advantage. Seeing nothing but green. They did have some red flags back in fiscal year 2013, where they spent a significant portion of their gross profit on R&D, but clearly that investment has paid off because now their revenues have exploded over the last 2 years in the data center category, and now they only spend about 13% of their gross profit on R&D. Everything looks good. Gross margin super high, selling, general, and administrative expenses are low, interest expense is low, profit margin is high, profits have gone up every year, earnings per share is blowing up every year. Their long-term debt is low. In short, everything looks really good. Next, I like to hop over to their financial statements and take a look at some of their numbers on the income statement. First of all, I can see that their shares outstanding has been dropping over the last few years. That's a good sign. It means that they've started putting money back into the company in the form of share buybacks, which I love to see. Most of these other rows are already showing up in my Warren Buffett red flag calculator. So I'm going to skip to the next sheet, which is the balance sheet. This one really sticks out to me. Their cash and short-term equivalents is up to $43 billion. Nvidia is just stacking up cash. In fiscal year 2024, they had $26 billion. Now they have $43 billion. So they are growing their cash reserves like crazy. And when I scroll down here to their long-term debt, they only have $8 billion in long-term debt. They could easily pay all that off. So there's not any risk with this company associated with their debt. Their retained earnings continue to explode. And now to the cash flow statement. On here, what I really like to look at is the free cash flow, obviously, and the way you calculate free cash flow is by taking the operating cash flow and subtracting capital expenditures. So in this case, $64 billion in operating cash flow minus $3 billion. So they're looking at about $61 billion in free cash flow, which is huge. Now, the next question is, how are they spending that free cash flow to benefit me, the shareholder? I can look at the other two categories here, investing cash flow and financing cash flow, to answer that question. So in terms of investing cash flow, they are investing a lot of money into securities. That is a good sign. I like to see that they're making investments with their cash. And then in the financing cash flow, we can see that they spent $40 billion repurchasing company stock. This is usually a really good thing, but this is actually my first red flag. When I look at Nvidia's share price over the last 3 months, yes, they've been coming down, but it's really over the last year that they were purchasing this stock, which could have been anywhere from $79 per share all the way up to $150 per share. The conclusion of this video is really going to tell me if this is a good thing or not, because if I come to the conclusion that Nvidia is a little bit overvalued, it means they spent $40 billion buying their own stock, which was potentially overvalued. It just makes it a little bit more risky. Now, of course, if things work out for Nvidia and they continue on this crazy growth trajectory, then investing $40 billion in their own stock will turn out to be a good thing if their stock price continues to go higher and higher. But if they come into some trouble into the near future or medium-term future, then that massive investment into their own stock could prove to be a huge downside. To me, that raises the risk of Nvidia a little bit. So the next step is now to calculate the intrinsic value of Nvidia. And the most important piece of that puzzle is estimating their future free cash flow. When you have a method like this of calculating intrinsic value, it's garbage in, garbage out. If you put in garbage estimates, your intrinsic value that you calculate is also going to be garbage. So this is incredibly important. How am I going to estimate Nvidia's future free cash flows? Well, my method is I like to take analyst projections projections for future revenue, and then use NVIDIA's past free cash flow margin. The free cash flow margin is the percentage of revenue that NVIDIA is able to create free cash flow. That way I can use professional analysts and what they're seeing for future possibilities multiplied by their past performance, and then I can get an idea of what the future free cash flow might look like. So to find analyst projections, I like to go to stockanalysis.com. That's where I get most of my information. The forecast tab right here, then I scroll down to revenue growth. And here is where the analysts are projecting the percentage growth of revenue year after year. For fiscal year 2026, all of the analysts agree that they are going to experience some serious growth. Now, those estimates vary quite a bit, everything from 97% all the way down to 32%. And then the estimates only get more varied as you go further out. In 2028, the highest analysts are saying 75% growth, and the lowest are saying actually 10% drop in revenue. So massive swings. That means the potential range of intrinsic values are going to be incredibly wide. But nonetheless, I'm going to paste this into my calculator and let's see what kind of results we get. One quick note is that in 2029, it looks like some of the high analysts did not give a projection, and the range got massively squished down. So I will be editing these right here in 2029 to maintain the spread of revenue projections. We can see that graph right here. The high analysts decided that they weren't comfortable making guesses for 2029 and 2030. They did not give any data, and now the remaining estimates are on the low side. So I'm going to make that spread a little bit wider. On the spreadsheet, scrolling down a little bit, this is where I pasted in the analyst revenue estimates. And so I'm going to adjust these figures right here. I'm going to make this one 30%, nice middle ground between 74 and 15. For this one, we'll make it 12, and we can keep that at -10. With that in mind, the intrinsic value, assuming the analyst projections, and this free cash flow margin, this is the average free cash flow margin over the past 5 years. The intrinsic value, according to the highest analyst projections, would be $238. Considering NVIDIA is currently at $100, this would be a huge upside. Like, this would be awesome. The average analyst puts the intrinsic value at $83, and that's using the average revenue projections. Whenever they pick a stock price, that's a different deal. I'm using the analyst revenue projections to calculate intrinsic value using my formula here. And then the lowest analysts are projecting $35 per share. So a huge range, massive downside with NVIDIA if the outcome is closer to the average analyst or the lowest analyst. Now, I do want to make a quick note on past free cash flow margin, because this graph right here, it shows their free cash flow margin, and the last 2 fiscal years, it has been much higher than 32%. It's been closer to 40, 44%. So do I want to boost up their free cash flow margin, considering they've been on a trajectory of having much more profitability? To answer that question, I first like to make a few changes to their current free cash flow. I like to account for stock-based compensation, because if a company is spending money on share buybacks, but then they're also issuing more stock as compensation, and that's going to directly counter out some of their free cash flow. So I count 100% of their stock compensation against them, but if they spend money on cash acquisitions, I will count some of that money against them too, because in a lot of ways, a cash acquisition is similar to a capital expenditure, and cash acquisitions are going to increase their future capital expenditures. So I do count some of the cash acquisition against them. And then in NVIDIA's case, I'm not giving them any credit for R&D, because I think they have to have high R&D in order to continue dominating the market. They need to be in the front at the bleeding edge of this technology. So R&D is required for them at this point. And then capital expenditures, they are growing their data center chip. Some of that capital expenditure is going to go towards growth. So I'm giving them 10% credit for capital expenditures. The new free cash flow margin is pushed down to 23%. The average was 33. It got pushed down 10% by making these adjustments. If I assume that their free cash flow going forward is going to be 44%, but I still need to reduce it by 10% due to these considerations down below that I just mentioned, then I think 33 actually ends up being a pretty good estimate. It just happened that the past 5 years of free cash flow margin does a good job of accounting for their future free cash flow margin growth and their current stock-based compensation, cash acquisitions, and capital expenditures. This estimate looks really good. So my next question is, do I think the highest analysts are going to be correct, in which case I need to be buying NVIDIA right now? Or do I think it's going to be closer to the average or the low analyst projections for revenue? To answer that question, first, I like to look at NVIDIA's own future revenue predictions. Their most recent quarter, their revenue was up 12%, which is great. And their projections for the next quarter is revenue up 9% sequentially. So they, in the short term at least, are currently on their same trajectory. But I am more concerned concerned with the long-term growth projections, because the highest analysts are saying 97%, 69%, 74%. Like, these are massive revenue increases. So how likely is that to continue? One way I like to analyze this question is to look at NVIDIA's risk profile. If I go to their annual report, I can see they have a whole section on their risk. And one of their big risks are dependency on third-party suppliers and their technology to manufacture, assemble, test, or package products. That reduces their control over the product quantity and quality, manufacturing yields, etc. It's no secret that NVIDIA relies heavily on TSM at this time. This is a Taiwan-based company, which is very close to China. So there is a risk here associated with China potentially invading Taiwan. There's been threats for years from China. There's no telling when this could happen, if it's going to happen at all. But nonetheless, that does fit into the risk category. And then the next risk I wanted to bring up is this one right here. We receive a significant amount of our revenue from a limited number of partners. So their top 3 direct customers, customer A, B, and C, they don't make them public, but people pretty much know, accounts for 12%, 11%, and 11% of total revenue. 34% of their total revenue is tied up in 3 customers. And they have a 4th customer that's also pretty large. Whenever I look up NVIDIA's largest customers, this is technically, I guess, speculation, but based on who is buying chips and who is building the most data centers, it's pretty easy to conclude because NVIDIA is the biggest player on the block. This article right here on Yahoo Finance shows, unsurprisingly, big tech companies like Amazon, Meta, Microsoft, and Google are believed to be among NVIDIA's largest customers, making up roughly 40% of their total revenue, tied up in roughly 4 companies. So that is a major red flag. If any of these companies were to no longer rely on NVIDIA for their chips, that would represent a huge hurt to NVIDIA's future revenue, which we need for this stock price to make sense. NVIDIA's future revenue to continue to rip, like really rip. The average analysts show really good revenue gains, 58%, 24, 16. I think I entered in 12 or 13% right here, and 11%. That's big revenue boost. But even if that's true, NVIDIA's share price is not going to make sense today. So that does represent a major red flag. The next thing I wanted to look at is their competition right here. NVIDIA lines its competition, suppliers and licensors of hardware and software for GPUs, custom chips, and other accelerated computing solutions include AMD, Huawei, and Intel. This article on NVIDIA's competition shows that clearly NVIDIA is dominating with 80% market share in 2023, 88% in Q1 of 2024, 88% in Q2. So they are crushing AMD and Intel. However, this is not the only competition. This is NVIDIA's competition that's looking to sell chips, but NVIDIA also has competition that are looking to make their own in-house chips. And that happens to be NVIDIA's largest customers. Alphabet, Amazon, Apple, IBM, Microsoft. These companies are all looking to produce their own in-house chips. And if they start to use their own in-house chips instead of NVIDIA's, then that is just as bad. Now, Meta is not listed on this article, but I found this article right here dated March 11th, 2025. Meta tests its first AI training chips, part of its plan to reduce reliance on suppliers like NVIDIA. So there are plans in the works for NVIDIA's largest customers to compete directly with NVIDIA. And if these companies are able to produce a chip remotely comparable to NVIDIA, who do you think they're going to prioritize? They're probably going to prioritize their own in-house chip, which is just going to be a little bit better suited to meet their particular set of demands and problems that they're trying to solve. And the final risk that's more of a recent development is the trade war with China. NVIDIA takes a $5.5 billion hit. Down here, it shows that NVIDIA designed the H2O chip specifically to comply with US import restrictions on China. They had to make it a little bit downgraded from their most advanced chips just so they could trade with China. And now with the latest trade war developments, currently we're over 100% tariff on Chinese imports, and China has put retaliatory tariffs on us. This has made NVIDIA's chips obsolete in terms of competing with other Chinese chip manufacturers. And China is not a small customer for NVIDIA. 13% of their sales last year were to China. And so if they were priced out of the Chinese market, that would be a significant hit. Now, there's no telling where the trade war is going to go, but it's just another element of risk for NVIDIA's future, which their future needs to go perfectly. The highest analyst projections need to be pretty close to correct for their share price today to be worth it. To see what kind of growth would I need to see for NVIDIA's current share price to be acceptable, I would need to see 30% average revenue growth over the next 5 years, followed by 10% revenue growth for the 5 years after that, and then finally a perpetual growth rate equal to inflation. That would give me a share price today of $102. And with all of the risks on Nvidia's horizon, their current share price is just a little bit too scary for me. I would want to see a share price of $83. I'm going to go with the average analyst projections for my fair share price that I would be targeting for Nvidia. So if I see the share price drop to $83, then I'm going to be scooping up Nvidia. But until then, I'm going to stay away. Not because Nvidia is not a great company. There's no doubt about it. Nvidia is a killer company. The problem is everybody knows that, and the share price has been pushed up as a result. The lowest it has gotten in the near future has been $86 per share, so it was close. In hindsight, I wish I would have just bought some then, but nobody can see the future, unfortunately. So if you enjoyed this kind of analysis and you want to invest in a company that's going to be benefiting from the increased technology and AI, the increased usage of data centers, if you want to be exposed to that side of the market, then check out this video right here where I found the ultimate semiconductor company. Check it out. I hope to see you there. Cheers. TX Whiskey.